All right, gangsters. We're back. It's Tuesday, 5 o'clock Eastern, and you know what that means. It's an all-new edition of What Are Your Thoughts, starring me and my co-host, Mr. Michael Batnick. Michael, say hello.
What's up, everybody? How we doing?
The chat is lit, Mike.
Okay.
Like lit. Everybody's here. Do some quick shout-outs. Purple Haze 33 is here. Great handle. Jay Minter. Josh was all rage pumping Mag 7 today on CNBC. Rage pumping.
You were rage pumping MAGA 7?
I don't know what I was doing. All right. KPS Fred. What's up, man? Akbar, Greg Olson. Who else? Cam Rackham. Adam Tronics giving us like a thumbs up thing. Good to see you. Ryan Edwards. All right. All the gangsters are here. We have a sponsor tonight. Quick shout out to our sponsor. The show is brought to you by Eaton Vance. Michael, what should we say about Eaton Vance?
That's right, Josh. I'll tell you what. When investing in today's market, passive isn't always enough. Highly rated Eaton Vance Short Duration Income ETF, EVSD, offers investors the active flexibility they need right now and over time. Unlike index tracking ETFs, EVSD leverages Eaton Vance's expertise to actively select short-term bonds, aiming for better risk-adjusted returns in a shifting rate environment. Active management can make the difference between standing still and moving ahead. EVSD also invests across a broad range of fixed income sectors, including U.S. government securities and corporate bonds, as well as mortgage and asset-backed securities, providing diversification that goes beyond traditional short-term strategies. Get active with EVSD. See how at eatonvance.com/EVSD.
Before investing, consider the fund's objectives, risks, charges, and expenses. The prospectus or summary prospectus contains this and other information and is available at eatonvance.com. Read it carefully before investing. Not FDIC insured. Offer no bank guarantee. May lose value. Not insured by the federal government agency. Not a deposit. Distributed by Foreside Fund Services, LLC. All right. Shout out to Eaton Vance. We have a lot to do tonight. I'm actually pretty excited to be catching up with you. I feel like we haven't spoken in a minute. How do you feel?
I feel that way too. You left me. You're in sunny Florida and I'm in fucking freezing. You know, the office heat is not working.
Is that
goddamn
true?
Freezing in here.
Wait, what happened?
I don't know. The building is just not working. Again,
we have a surprise.
Edgar Denny. Oh no,
it's Adam Parker. Oh my goodness, what are you doing here?
Hey guys, how are you?
Adam, we're so happy to see you. You know, it's such a coincidence that you dropped by because we were about to discuss a piece of research that you put out last week that both of us had a pretty outsized reaction to. I was really into what you wrote, and I think the topic is so good and so evergreen. So it's so great that you're just randomly in the neighborhood, and now we can get it right from the horse's mouth. Guys, Adam Parker from Trivector Research is here. Can you tell everyone the difference between Trivector Research and Trivariate? Because a lot of people know you as Trivariate Research, and I know this is a different effort of yours.
Yeah, Trivariate, we sell our research and bespoke services and events to institutional investors, asset managers, hedge funds, allocators, corporations, law firms, boards, management teams, etc. Trivector is just for individual investors and financial advisors. We sell insights, what to do when you get new money, is ETF analysis. We hope a quirky, interesting newsletter that kind of piggybacks off all the stuff we do at Trivariate.
Well,
so it's $100 a month. You get a free month if you sign up today. So check out the Trivector Research.
Okay. Well, you came to the right place. We have plenty of financial advisors and individual investors here tonight.
Cool.
So really glad you stopped by. We have Adam's mic is okay, guys. Let me hear you one more time.
Adam Parker.
Got you. All right. All right. So can you tell us about this piece that you did about broken compounders?
Sure.
And it's nothing to do with us at the compound.
No.
But
yeah,
it's one of my
come from.
You guys aren't broken.
Right, not yet. It's one of my favorite topics. Like, when do you buy the dip in some of the most popular stocks once they stumble? I think it's like, this is such an evergreen topic, and I've never really seen somebody go that deep on it specifically.
Yeah.
Like, all right, you've got all these stocks now that used to be compounders, and
Yeah.
some of them have had a really rough go of it. Like, how do you know if they're going to get back on the horse or not? And what are you looking at? So I loved what you did. And why don't you set the table for us and tell us why you tackled this and what it's all about?
I mean, I tackled it because there were names that were like, I would say, beloved stocks. United Health for years, massive outperformer. Fiserv, I know guys who owned it for 20 years. Like stocks that people just felt like were steady, compounding businesses. You look back, they're up 20% a year on average over 5 years. You hold them. Classic financial advisor, like you'd want to own those kind of stocks and hold them. And then they have like these periods where they get decimated. And I think mostly, at least long-only portfolio managers owned United Health, and it really hurt them before they figured out that they should get rid of it earlier in the year. And then, like you say, some of them come back this summer and say, well, wait a minute, maybe I should buy it, or should I? And so when we do things, we try to do it systematically. You and I could probably cherry pick names that we think are compounders, but when you come up with a set of rules, you kind of have to do it more systematically. So we decided it's got to be up 100% at least in 5 years. It's got to have done that with somewhat low volatility to kind of qualify as a compounder. And then it has to go down by a certain amount that it hurts. So we studied what we thought makes sense, and it was 30% in a month. It was something like,
so like a stock getting just murdered after earnings,
or
earnings something bad happens.
Yeah, exactly. Okay. United Health is a perfect example from earlier this year where it just went in half in sort of a 3-month period. And if you're a index to S&P guy, like you owned it. It was big, and I know I probably have. I know I complained about it on Compounded Friends because when I did it, I had about 10 of your listeners be like, "Adam, do you need help with your healthcare plan?" So I remember saying to myself, "Don't complain about UNH's pricing power over Trivariate on the next."
Okay, now you exclude biotech.
Yeah, and that's because they're down 30% a lot because something's unsafe or drugs ineffective or whatever. So I didn't want to get wrung out by those guys. And then, when you do it, you do pick up names that maybe classic PMs wouldn't call compounders because you're starting to pick up something that might be up a ton, but it was up. You might pick up a MSTR or something in there because it was up so much that it fits, and maybe people wouldn't call it a compounder. So you have to kind of deal with, when you do systematic things, what comes out of it. But we have a list, and then we sort of studied, okay, once they're down 30% in that first month, what happens after that? And I think that's what you
Well, so let's explain to people the timeliness of this research that you've done, because you note we in the year 2025 we have seen the third most broken compounders after the financial crisis and COVID.
Right.
So it's like this is the right market to be looking at broken All right. So tell us what's in this chart.
Yeah. So this is just how many kind of stocks fit that bill of down 30% in 1 month after being up 100% or more with somewhat low volatility in the previous 5 years. So yeah, exactly. The timing. I didn't, full disclosure, I didn't know it was going to show that. I was more just thinking like, man, this UNH, do I want to buy it? And this Fiserv, and, and there's, so I just started to study it. And then when that came up, I was like, that's a pretty big population. So the answer is we studied about 520 stocks that fit the bill over a 20-year period, which, gives us enough to play with in terms of studying distributions of outcomes and right. Returns, and trying to slice and dice it to say, okay, maybe there are some attributes I want to at least avoid. Because one thing I've learned, and I learned this when I was on the buy side, is generally, and we show it in our work, this is not a good asset class. Like once they're down 30 in a month, the basket of them on average is still bad. So there may be some things you could skew your odds a little, and I think Michael has some ideas of stocks in the broker compounders he likes, but the asset class itself is an inferior asset class.
Yeah. So, but before we get to like what happens next and what are some of the similar characteristics of these names, throw that chart up one more time. What's fascinating to me about this is look at the previous spikes that are comparable to, I guess, October. You had, of course, the GFC, no explanation necessary. And then you had the rate hiking cycle that looks like late 21.
Yeah.
And then you had like I wouldn't say. Well, I guess what would you say? What would you say October was? Because that was before Sam Altman, or does yeah, that was before Sam Altman. So is this just general AI disruption?
Yeah, I mean, I think.
Well, Oracle's in there. That's an obvious one.
Right.
So
But
Oracle
Josh,
fell
but that's
30% in a month.
But that's through the end of October. So I don't know if Oracle did that through October. Through November it did. I don't know if Oracle's
No,
on that list.
I think notably, Oracle was one of the mega caps that literally fell 30% in a month.
Yeah, I mean, the issue, I guess, is that we had so many stocks that were up 100% or more in the previous 6 months.
Fiserv is probably on the list this year.
Fiserv is on the list. F5 is on the list.
So Oracle's not on the list because Oracle
is on the list. It is on.
But wait, hold on, Adam. Not to, but through the end of October, Oracle was only down 20%.
So
whatever, it doesn't matter.
We look at it from October 16th to November 14th, and it isn't in a calendar month; it's in a rolling 1 month period.
But the broader point is also that, of course, we understand what's causing this, but this normally happens in shitty market environmps. This is not necessarily.
That's a good point.
November was rough, but like
run up. It's a big run up followed by something shitty, and so if you think about 07, it was 03 to 07 were monster years for the equities before the financial crisis. Kind of same thing with 2019. I mean, you had crazy moves in markets before the rate, and then the COVID and all the PPP and stuff. So you had some big recoveries from March 20 till end of 21. So it's not that surprising. It's a combination of lots of stocks ripping, and then I think a little bit of fear working its way into the market. And
so
the
most
penalty
of these
for missing
companies
has been huge.
Most of these companies, you break them down into different quartiles of quality, and not surprisingly, for the most part, these broken compounders are junky, expensive stocks that tend to be in and around technology and consumer discretionary. I'm guessing that is what you thought you would find.
Yeah, I mean, there's more compounders in those areas, so there's going to be more broken ones. I would say, I'm looking eyeballing, and I don't have my piece of research in front of me, but it looks to me like 255 of the 520 were top half quality. So yeah, it's a little bit more junk than high quality, but maybe a little less than I would have thought. I had a couple of institutional investors come back to me, Michael, and say, I don't care about any of this. I only want to look at the high quality ones because I didn't own any MSTR ever. That made your quant definition, but I never called that quality. And even when we studied just that smaller population, the results were pretty much still the same at a high level, which is, and I guess we're going to get to that, but the basket underperforms even after the 1 month it's down 30 or more.
Well, let's get to that. So the first takeaway is this is not a great pond to fish in generally.
Right.
Okay. But what's the bigger takeaway here? Like, what does happen after they fall 30%? What's the typical path?
On average, they continue to underperform by another 10% versus the industry they're in over the next year.
So once they break,
versus their peers,
you got to bail.
And I always look at it versus the peers because I don't want you to be like, hey, Adam, no shit, semis are better than staples or whatever. Like, you got to adjust for what sector it's in because otherwise you might be, creating an inherent bias. And so all the returns we show were relative to the industry group, the like S&P 25 industry group, just to make sure we're kind of comparing semis to semis and household products to household products or whatever.
This does tend to happen more to the most expensive stocks, which makes sense. They have the highest expectations built in. Put that next chart up. Count of broken compounders by industry relative. Yeah. So this is a phenomenon that it's not only the most expensive, but this is where the potential for those kind of mini crashes resides.
What I think is the single most interesting thing here, and my guess is you have that coming next, and we didn't. I just popped by it and we didn't schedule this, but the exhibit that shows the attributes of the worst ones are highest forecasted earnings growth, and obviously those are correlated to most expensive, right? Okay. And so when you get really high forecasted earnings growth and you disappoint, that's when there's a longer tail to the underperformance, and I think that's capturing a lot of these. It's like Oracle, or a company misses and it just resets expectations, and they had really high expectations and really high multiples, and then all of a sudden it can be down 30, 40, 50%. And that, you saw that with UNH, where the numbers came down a lot. It wasn't just the first downward revision.
See, I was really surprised that the evidence didn't show that there was like a snapback, because just like, and this is anecdotal, I don't have different data than you. I'm just like, I think of some of these things as being opportunities, but I guess like as a group they're not, although there might be some specific one-off examples where they are opportunities. And I think that's maybe why people tend to like get really excited when they see a company they know get slaughtered. Their inclination is like, this is going to bounce.
So there is a bit of like, when you slice and dice it and you just look at the high quality, you just look at the mega cap, which there weren't too many examples. There is like a 1 week to 1 month bounce on average, but then by 6 or 12 months out, it fades. So I think that's like the old dead cat bounce phrase of like, I mean, my conclusion was, if you're short one of these things in advance, like there's no reason to cover. Like you probably stay short. I mean, you guys know momentum is pretty powerful. You don't want to short a stock at highs. That's for damn sure. Right. So, I think it's a little bit the complement or whatever of that, of like, they're likely to, what's it called, like serially disappoint. And just because they just went down once, like on average, they're bad. I think if it's a mega cap, it's higher quality, maybe you cover the short. But if it's anything else, like you probably have more room to run.
We have a table of this is so. This is your chart of the latest 15 broken compounders as of November 17th.
Yeah, Oracle's on it. Look, Michael. Yep. Yeah.
So let's read, because for people listening, let's just give people an idea of what we're talking about. Synopsys.
By the way, I would have called Synopsys a true high quality compounder. I mean, they got the NVIDIA thing this week, and maybe that creates a little bit of a cap. But that's one that I
barely went up.
I would have been tempted to buy that one as an example, personally.
Yeah.
Kind of
Hims and Hers is on here. I feel like that stock is always up or down 30%, depending on what day you're looking at it.
Up 582% in the previous 5 years, and then down 30. Yeah.
Elf Beauty, Super Micro. What's also interesting, Riot and Mara are on here. They're Bitcoin related, just like Strategy. What's interesting is like some of these names are, I don't want to say meme stocks, but like whenever the ticker is scrolling across and it's showing the highest volume or the most actives, like these are in that group of like retail stocks that people love to trade.
And look at the junk, like the junker quality that we show. Like a lot of those are the junkier ones that are like the high beta ways to play. Like ACTS, same thing, right? So that I don't. That's why I had some institutional clients say, I don't want, just show me the high quality ones only.
Because Oracle is low quality.
Yeah. I bought Oracle. I bought Oracle last week, and it got rejected pretty disgustingly today at the 200-day. If it rolls tomorrow, which is looking likely, I'm probably going to bail. So when you're talking about quality, that's what you're looking for. How do you
we have a quantitative tag: high, mid, low quality, or junk, are the 4 buckets. We tag stocks monthly, the top 3,000 U.S. equities. We're looking at attributes like level and stability of return on equity, free cash flow generation. We then penalize some things like if you have a lot of leverage, or if you have ever cut your dividend, or if you turn over your share base, if you have a lot of short interest. Like there's a whole bunch of calculations that go into it. It depends if you're a financial or not. If you're a financial, we use Tier 1 capital ratio and other things they give you for free that are quality gauges. So it's a quantitative tag we do monthly. And Oracle is an interesting one. They have a decent amount of leverage now. They have negative free cash flow, and so it could have been higher quality 6 or 12 months ago, but it's getting a little bit lower quality. And I think that one's really interesting, because I feel like most hedge fund guys I talk to in the pod space, it's just been the easiest AI short, because they've got to run neutral to a lot of these factors. And for them, it's just big and liquid and easy to short. And it's more confusing to figure out when and why to short Broadcom or NVIDIA, so it's more a function of the debt, I think, and the perception of their position.
All right. So to sum up, the first thing is, when you see a stock that had previously been a compounder, stock that had doubled over the last couple of years, low volatility, everybody loved it. When you see it break, like really break 30% or worse, that is not in and of itself a quote unquote opportunity. Really important point.
Yeah, it's probably more likely to continue to be bad than good. And the thing to most avoid is if it has really high earnings expectations.
Right. Now, if you still are undeterred and you must buy it, understand Adam's research shows pretty convincingly that it's more likely that that stock is going to underperform its peers, and maybe what you're better off doing is picking a different name in the group. Would be another takeaway.
If you have a 1 week horizon, maybe you'll catch
anything
that bounce. But if you're 6 or 12 months, the distribution's pretty negative. That's right. Yeah.
Okay, now if you're betting against one of these names and it breaks, that may not be the entirety of the gain. There may be more to come if you're inclined to be short or stay short. I think a lot of people would be very happy to just take a gain like that on the short side, just like you would on the long side. But you're showing hedge funds, hey, maybe that's not the signal.
I know guys who shorted United Health after they were long it. I mean, they were long, it went down 30, and they were like, I don't know what this thing's going to earn, and I'm going to short it. And they picked up, some of the money they lost on the short side. So I do think that the data show you want to, on average, continue to short it. Now, there may be individual names that you've done fundamental work, you think it's overblown. I don't know if it's, Adobe or whatever, people want to look at, but you're fighting in choppy waters when you do that.
Adam, you do awesome research. I want to just thank you so much for completely serendipitously stopping by this evening.
Yeah, I mean, can we get some wine next time or something when I stop by? All right.
Absolutely, I'm gonna break out the Entenmann's the next time we have company.
Little raspberry Danish. All right, I'm in.
Yeah, I want to tell people where they can get more research like this directly into their inbox. We want to send people.
Yeah, TrivectaResearch.com.
TrivectaResearch.com.
www.TrivectaResearch.com.
Okay.
And it's $100 a month. You get a 1 free month because you listen to you two.
Okay.
And we'd love, I love hanging out with you guys. Happy holidays. Happy New Year.
Awesome.
Thanks.
Hey, thanks for all your great work this year. Happy holidays. We'll see you soon. All right. Wasn't that cool?
So, Josh, I wonder if I were to ask you the question, what do you think generally happens? Now, I know we know the answer, but what do you think generally happens after a stock has doubled within a 5-year window and then loses 30% of the month? I think you and I would both say probably best to avoid. Like when that sort of reset happens, there's something really gnarly going on. And forget about the short-term dead cat bounce. That is probably not a stock you want to buy and hold for the next 6 to 12 months.
You're right. I would have guessed it, but it's so nice to actually have the data and to see all these real examples of it. And I have to tell you, I spent the first 10 years of my career data free, and just my instinct was always you would see a pharmaceutical, not a biotech, but you would see Merck blow up because there's a product recall, or you would see anything like that. And you'd just be like, oh, that's a big giant name brand company. I've made money in it to the long side. Now it's getting killed. This is a perfect time to start a position because you don't know.
Yeah.
You're acting on instinct and you're acting like a child. And having that data, maybe that's the thing that protects you from that instinct. And I don't have that instinct anymore, but I for 10 years, I ran myself ragged, and banged my head against the wall trying to do stuff like that. And, it's nice to know that it doesn't work for anyone.
Josh, did you guys talk about Apple on the show today?
Yeah. They cleared, it was very apparently in the tech press. What Apple did today was very widely expected. They cleared the decks of all the failure people from the Siri relaunch, which didn't work. The Apple Intelligence launch, which didn't work. They got rid of a whole bunch of people and they brought some new people in. All these AI people are in the same orbit. They're ex-Microsoft or ex-Alphabet, or in some cases both. And they're kind of cycling through. But apparently the tech reporters were all yeah, this is a long time coming. So that's the extent of what we talked about with Apple. But the stock hit a new all-time high today, yeah?
Yeah, so the stock is up 14.5% year to date. Market cap all-time high of $4.2 trillion. And I was just
no AI in sight.
Before we jumped on. So Apple hasn't fallen. I have to fact check this, but I'm just eyeballing it. Apple has not been outside of the top 3 market cap for the last decade. Is that nuts?
I mean, it's nobody. Here's the bottom line with Apple. I can't tell you that it'll ever grow the way it was growing in the 20 teens, but like people will not stop using its products. The lock-in is just immense. And it doesn't have the multiple it has because we're overestimating its future growth. It has a multiple it has because people know in the end they're going to deliver. It's like the earnings will be there because the ecosystem lock-in is like airtight.
How about this? Know what else? Know what else? Apple, I guess never say never, but let's just call it within the next couple of years. Apple will not be a broken compounder. What in the world would have to happen for Apple to fall 30% in a month?
I mean,
like honestly,
something real. Like I'm trying to think like what could make, because the way I would tackle that question is what could make people all of a sudden reject their Apple products.
Right. Absent a market asteroid, right? Like absent like a COVID type.
The only thing is like a massive security issue, and Apple is like the gold standard for electronic device security and network security. Like, so if there was some massive hack where 1 billion devices all of a sudden started feeding information about their users,
that would hurt.
That would be maybe that would be the thing. I do want to address in the chat. A lot of people are asking what happened to Scott Wapner today. Scott's fine, guys. He needed a sip of water. He's a little dehydrated, but he's perfectly fine. And no story there, no conspiracy. Okay. He's all good. Spoke to him after.
I want to talk about the balance that we've experienced. So 2 weeks ago when we were in Texas, we spoke with Warren and we were like, oh man, this is not going to age well. And then a week later, it's like, holy shit, we closed at a new all-time weekly high. Like last Friday, the S&P had never in the history of Fridays closed higher than it did. Blew my face right off my torso. And then follow through.
Face off your torso.
Like it keeps going. So Duality Research, a company whose work I respect tremendously, made an incredible chart showing the S&P overlaid with a very short-term 5-day moving average of the S&P 500 advanced decline line. And we just got the highest 5-day advancer count in more than 10 months. Like, what a freaking bounce, dude.
Yeah, and I actually called for the RSP chart on the air today because it's really important for people to understand that what's taken place since, I guess, the AI swoon of late November, like right before Thanksgiving, things got a little shaky. What's taken place since then isn't like another bread thrust, right? And the RSP, I don't know if it ended up hitting a new high today, but whatever, it got damn close.
Yeah.
It's back at its previous highs from the rest of this year. So the equal weight S&P is confirming. Looks amazing right now.
Yeah. A lot of notable things to discuss about November, and we did all of it with all of the tech trade and all that sort of stuff. But it was an unusual month for many different reasons. But the leading sector, and by the way, the market was actually up, hard as it is to believe in November. What drove returns was healthcare. Like tech took 1.5% away, or like away from the market, and even still, healthcare, comm services, that's Google obviously, financial staples, coming up the rear and bringing the market positive.
It's really hard to get bearish when the leadership in the market falters, and all of a sudden you have a healthcare company become $1 trillion, and you have all that money that wants to be invested find other games to play. And they buy JP Morgan over $300 a share, and they take Morgan Stanley to a new year high. And it's like these are also big market cap stocks. They're not Nvidia, but in the aggregate, like Berkshire, JPM, Citi, they're big stocks, and the money was flowing. And then you look over at healthcare, you got the AbbVies of the world, and those stocks are making new highs. So like, how do you get bearish when you look at your fellow investors shifting their bets from one stock to another rather than from stocks to cash? Because that's what they did. They said, oh, this AI shit is not playing out nicely. Okay, what else could I buy? That's the environment. Like what? you shouldn't need me and Michael to tell you guys that's what a bull market is. That's what should happen, and it did. It's really fortunate that it did. I also don't think healthcare is being bought because it's, quote, defensive. It's not. That's not my read of the situation. I don't think they're buying the GLP-1 stocks because they're looking for defense. They're looking for growth. I don't think that's like a rotation to safety. I'm sorry. I just don't think that's what's going on at all.
When you and I were speaking with Joe, we were talking about it's just the market feels weird. Like there's a lot of just weird things happening within the stock market itself. Looking at the band-aid of the RSP, SPY stretching and then snapping, just completely falling through the basement. And we saw a nice rebound subsequently. But I saw this data point this last week.
Well, wait a minute. Before you move on from that point you're making, what's the benchmark of a normal year? Market feels weird versus what? Like 2019?
No, I mean, listen, I understand that every year is a little bit different in its own right, but this just felt particularly unusual. I'll give you an example. I think this chart is from Grant Hawkridge. Sam Gatlin tweeted it. Maybe Sam created it. I don't know. But it's a wonderful chart. And it's showing the number of 1% up days per year versus the number of 1% down days per year. And Sam tweeted that 2025 has been a weird year. There have been more big down days than big up days. And of course, this is not a bear market, right? The market is up 15% year to date, whatever it is. Sam writes, the last two times this happened, the market was in a nasty bear market, obviously, as you expected it to be. 08 and 2022. It's just been an unusual year.
So I guess my take on this would be, it's interesting to know, but my take on this would be like, the hallmark of like a true bull market year is not big up days or bigger up days or more big up days than big down days. Like the hallmark is the grind higher, the relentless, like 4 out of 5 days every week. And that's what at least the fall has felt like. I know it hasn't been like that the whole year, but for the most part, like that's what bull markets make me think of. They make me think of like, market's up and it's green. Market's open and it's green. Market's open again. Oh, hey, look, it's up. Like that's really what I expect from bull markets. I don't expect those explosive up days. Those to me feel like you should be looking for those in bear markets. You know what I'm saying?
I do know what you're saying. So the poster child of what you're describing, throw that chart up, please, is 2017. And I didn't notice this until you just mentioned it. Throw that chart back up, please, John. So 2017, if my eyeballs are correct, is that little tiny like divot in there. You see that one in the middle where there's like no up days and no down days that are over 1%?
Yep.
That was 2017, which was in itself a weird bull market. It was just that was truly a slow grind higher. The S&P was up like 20-something% that year. And it was very slow and deliberate. There was no big up days. But anyway, the point is that you're right. A ton of up days does not necessarily define a bull market. It's just unusual. And it's unusual because what happened in April, right? A lot of the big 1% down days came in April.
Do you know what the headlines were in the financial media in 2017? They were, there's not enough volatility. Wall Street is not making any money because there's not enough volatility. Like I want people to understand, and I don't have time to like go back and Google this and find all these articles, but I'm telling you, this was in the Wall Street Journal. This was like in The Economist. Like anyone that wrote about markets in that year, they were writing about the quote unquote dangerous lack of volatility in the market.
Here's from the New York Times. This is what you're talking about.
Read it.
So by Neil Irwin, the stock market is weirdly calm. Here's a theory of why, and that was in the middle. That was in May. Now, Josh,
and it was problematic. Was the point?
The juxtaposition of political volatility, not filtering it to stock market volatility, that had people like, this is weird.
All right. So I was doing TV shows with active traders throughout the course of that year, and people were like angry. Like, oh, this is so boring. It tells you that the financial media needs for there to be drama, and if there isn't any, and you have a year like 2017 with no big up days or big down days, I think the market went up 30% that year-ish. People still found a reason to be upset because there wasn't enough trading volume. There wasn't enough volatility for certain strategies to make money or certain trading desks to benefit. So I guess my point is that every year is weird. And they're weird in different ways. Because I wouldn't say that 2017 was a normal year. I would say that's completely aberrant.
Yeah.
To have that little volatility.
So I pull as I'm looking through the Google machine into like headlines from 2017. I found one of your posts on LinkedIn. My big takeaway from 2017.
Oh God, how dumb is it? How poorly did it age?
I'm sure it aged perfectly fine. All right, let's talk about Adobe.
You're making the case tonight, so I'm not going to make the case per se. I'm going to present the case.
Can I tell you something else?
Is that semantic?
Can I not bury the lead? I didn't tell you this, but I'll tell you now. I bought Adobe today.
Oh, shit.
All right, so let's go.
Maybe I'll make you feel better about it. Is this a generational bottom? Or could it bounce from here, but it's a company still in a long-term secular decline?
I don't know shit about Adobe. I listened to the conference call today to get a little bit educated. Because Adobe,
tell us more about your process.
As the CEO said, fuck off. This is my own money. They said, simply put, Adobe is the operating system for creative work. And of course, creative work is the epicenter of the AI disruption. My hashtag, quote, thesis, and I'll sell if I'm wrong, I'm not like married to the stock, is that Adobe is understandably being punished, but to extreme levels, and analysts are not backing down. It was a great call. It was a beat and a raise. And I think that they are going to be a massive beneficiary of the AI transformation. I don't think that all of a sudden all of their enterprise and Fortune 500 customers are going to dump Adobe and start using Banana Hammock or whatever it is, and the chatbots and just cut them out. I don't buy it.
Okay. I don't either. I just don't know if that will matter right now. But I
totally agree.
Yeah. So I actually think that there is a world in which Adobe sits on top of the entire silo of AI tools, and the user interface that they provide, whether it's Creative Cloud or Firefly or any of the tools that they've been selling to creative people for, 35, 40 years, I think that people like their workflows in those Adobe products. And as Adobe amplifies the power of those products with AI, they will keep those customers. I don't see everybody cutting their licenses and just being like, you know what, I'm going to have the AI create all this stuff for me.
No.
Professionals especially. So
if you listen to the call, you would never guess that the stock is down 55%. John, throw this chart up, please, that I had ChartGoat make, the earnings one. So we've got a chart. Josh, this is unbelievable.
I know.
I'm sure there are other charts that look like this, but for the listener, the earnings per share are literally at an all-time high. It was a record quarter. And yet, the market is saying, I don't believe that your earnings are sustainable. I believe that you are absolutely effed because the forward PE is at a decade low. This is very, very unusual. And the market's either very wrong or very right.
I want to get to some of the comments in the chat because people have really strong opinions about this. And I sort of agree with some of these points. Figma's in a partnership. Adobe's in a partnership with Google long term. They always have been. But Figma is too. And Figma came public earlier this year, raised a ton of money. And they're not competing with Adobe in every part of their business, but they're a mainstream player. I think it's worth bringing up that might account for some of that PE multiple decline. Let's see. Big Bob's Barnyard points out Adobe has ripped off professionals forever, and they have been wanting competition, and now they have options. The professionals won't come back. All right, so I think that's probably an overgeneralization. I'm sure people do like that there's competition that'll be a lower price. I don't know that everybody leaves just because there's a lower price competitor. Last one. Brian McKeon says, or two more. Adobe missed the boat. Could have been the new Hollywood production with direct-to-consumer platform. Hope they catch that wind. They are. So it's not Sora. They're not trying to be first. And the truth is their direct-to-consumer business is not as important as their professional business. Kimball the Nimble says Adobe logins at its website are designed by someone who is trying to make you confused. Interface has sucked for years. All right, look, there are very legitimate problems with Adobe. I think that's reflected in the stock. It's at a massive drawdown.
55%. All the problems are very much well known. Nobody's surprised.
Look, I remember Apple in 2013 selling at a 12 multiple, and Carl Icahn came in, took a huge position, and they asked him, like, aren't you worried about competition from China and Android? And his comment was, okay, it's 12 times earnings, though. Like it's eight times earnings backing out the cash. I don't know if Adobe is 12 times. We'll get to that in a second. Put up the chart. Here's 1 year.
Ugh.
Disgusting.
Okay. Yeah,
disgusting. But everyone knows.
Yeah.
It's not like we're not revealing anything.
Right.
Everybody gets it. Everybody gets it. Here's a 10-year chart. Erased
all of it.
I don't know, half a decade's worth of performance. Like this is very, very, very well understood.
So wait, Josh, this
company
very
might
much,
be in trouble.
Yeah, this is very much not a compounder, right? If somebody's like,
No.
"Hey, dumbass," didn't you just hear what Adam said? That's not this.
No. And this
not
didn't
this.
collapse 30% a month. It's not
And
a
then
broken compounder.
and it was not up 100% in the past 5 years at all.
Let me show you Adobe 3-year chart versus. I want to give you some perspective. Salesforce, which is in blue, this is 3 years, is up 60%, and that's an underperformer. The iShares Expanded Tech Software Sector ETF, IGV, is up 89% in the same period. This is just back to December 22 when ChatGPT came out. That's why I'm showing you this chart, guys. The start of the AI age. Adobe's now negative 6% for the start of the AI age. Now, are they going to lose seats? Probably. Are they going to have to cut some of their pricing on some of their products? Maybe, because I don't think this AI stuff is going to be free. No offense. Are they going to be the company that figures out how to successfully commercialize AI tools and get professionals to pay for it? I'd say abso-fucking-lutely.
Yeah.
Here's I did an Adobe versus its P ratio too. I did it in 2 panes. Put it up.
Yeah.
You know what I'm saying?
Yeah.
Like, if you think you're the first genius to be like, oh, Adobe's threatened by AI, dude, everybody understands that. Not just the stock price, but the valuation. It's crazy. One other thing I want to say about this. Oh, Adobe is buying back stock.
Tons.
2.5 billion, a new agreement from Q3. They have 8.4 billion of the $25 billion prior authorization still left to do. So this is a company that could conceivably be buying like $11-12 billion worth of stock in the very near future into a multi-year low. And I want to show you the shrinking of the share count. Put this chart up. This is shares outstanding. You know, a lot of these software companies, the share count is growing because they're issuing stock options like crazy. And with Adobe, they are like, this is like the classic kind of stock that like a Berkshire would have bought back in the day. Look how they're shrinking the float. It looks like it's down. I'm eyeballing. What is that, 25%?
Yeah, it went from 500 million to 420. Well, guess what? They report earnings next week or in 2 weeks, so we're gonna hear from them soon.
Well, I have more on this. Is this like buying Alphabet last summer, or is that a bad comparison? Because people are saying a lot of the same things, that Google is existentially endangered by AI. Is that a bad comparison?
Well, it's not bad in the sense that they're under the same threat. The difference is Google addressed the threat and neutralized it and leapfrogged it. I don't know what Adobe could do or say that would lift those concerns. So I don't see Adobe like doubling and retaking its all-time high. I just think that there's so much pessimism in the name, and I think that it's too much. But listen, it could easily fall 15% after earnings. Like, I don't know.
Okay, because I made that mistake with Alphabet. I believed in that story more than I should have, that they had this existential threat from OpenAI and others.
But here's the thing.
So play out that way.
So last time they reported, it was 11% growth, a beat and raise, and the stock bounced for like a minute. Like nobody believes it. So I don't know what they would have to say that would all of a sudden lift those concerns. But we'll find out in a week or two.
Only product, like only launching things that catch on. So like launching, but the problem is they're not an AI company. They can use other people's tools and they can provide ports so that these new things that are invented can be used in the Adobe environment. But they, unlike Google, I don't think that they can invent their way out of this. I don't think they could partner their way out of this. So that's why
they're partnered with everyone. They're there.
Already.
Yeah.
Wall Street has not given up on this story.
No,
it's a $320 stock. Pull this graphic up. The high target on the street is 605. Can you imagine? The average target's 452. It's the $318 or whatever it is. 24 buys, 4 overweights, 11 holds, 2 sells. For a stock that's down this big, it's pretty remarkable. I want to give you some commentary here. Barclays just raised its target after the last earnings report from 460 to 465. Firm pointing to outperformance in net new annual recurring revenue, key progress in AI, noting that AI first ARR more than doubled over 2 quarters. I don't know. I got a whole bunch of price targets, some raised, some reduced. It's a battleground name. The one thing I want to say is that in Harvard, when you go to Harvard, one of the case studies they teach you in business school about disruption is from 2014, when Adobe went fully subscription. That's 11 years ago. Adobe was the first company to successfully take its entire business model of selling people software and change that to getting people to subscribe to their services. And when they did it, the stock became a compounder. It became one of the best performing stocks in the market. So this is a company that's got a heritage of completely remaking itself when the gun was to its head. Mm-hmm. And Adobe did that. So the question is, can they reinvent vertical AI, what they're calling, and have this user interface on top of the LLMs that customers will pay them for? And we don't know, but I do think technically I like an entry here. I like 275 as a stop. That has been the line in the sand before. I think it's a relatively low-risk entry, and we get to find out together.
Yeah, I mean, listen, we know that surprises usually happen in the prevailing trend, right? So maybe I'm an idiot, but I'm taking a shot. And if I lose money, won't be the first time.
Is that where your stop is? You want to reveal where your stop is for everyone who's watching?
No, I'm not telling the robots where my stop is. I'm not telling them. Come on. All right, let's keep moving.
All right, we'll do this quickly. Surprise. Chart on. This is an ad from 1966. TIAA Cref designed this ad to scare people into saving for retirement. This is going viral now as sort of an inflation meme. Look how accurate these price predictions were. So the ad said, and when this ran at the time, people were probably like, oh, why are you trying to scare people? This is like a magazine ad. They say in 30 years, a burger and fries could cost $16, a vacation $12,500, and a basic car $65,000. I think that's the average purchase price of a car in this country this year is $60-something thousand. I think that's the number, like that's on nuts. The nose. Burger and fries 16, maybe without the fries. I don't know. How much is it? How much is like not McDonald's, but like if you sit down in a restaurant and order a burger, it's probably $16.
Yeah, easy.
Right? I know you're a Minetta Tavern guy, and that's probably $30, but
ooh. Ooh.
Vacation, 12,500. I fucking wish. I wish. Your Disney trip is not going to cost you 12,000. I'm going to predict upside from there. What do you think?
I don't think it's that much more, to be honest.
How many days are you going?
No, it'll be like around there, probably 5, 6.
All right.
Yeah.
Anyway, the wake up call from 1996. It's 30 years later. That's what ended up happening. If you made this ad today, what would you have to put in for these things? What would you have to put in? What do you think a burger and fries will cost 30 years from now? $100?
That's a weird thing to think about.
I know, but
don't think about 100. Let's say like legitimately in 20 years.
30 years. 30 years, not 100 years.
Okay.
This was from 1996. So 30 years ago. So 30 years from today, what would you guess a burger and fries will cost?
I'm looking right now.
You fucking calculating it?
Yeah.
You're such a nerd.
I'm telling the machine.
I'm saying
$20.
$100.
It can't be.
Why can't it be?
All right, dude. Are you making the case of Bitcoin? All right. No. All right. Thank God it can't be. So I just did $20 compounding at 2% a year. Right? Is that reasonable for a burger? Why would it compound at more than 2%?
I don't know. What do you get?
That's $37 ish.
$100. Minetta Tavern.
Stop. $100.
All right.
Burger. How about this Pulp Fiction? It was a $5. It was a $5 shake.
Don't you feel like there are $37 burgers now in Manhattan, and it's just like accepted?
Yeah,
Vegas,
no, you could find it. You could find
Vegas
a
and Manhattan.
burger. Absolutely.
Yeah, like everywhere almost. How much is the Au Cheval burger?
Worth
right?
it.
Like no, I agree, but how much is it? How much is like that cheeseburger with the egg on it?
Au Cheval.
Oh, 18. I'm
18
tripping.
Steal.
No, stop. The cost of an Au Cheval cheeseburger is
in New York. It's
$30.
$26.
Yeah, when ordered with the popular additions of a fried egg and bacon.
You're not going to take the egg
And
off.
I don't know why. And I don't know why you would order it any other way. Are we? Did we lose a war?
We're not animal.
All right. All right. That was that. And then last thing. Will it piss you off, because this is coming, when OpenAI starts to run ads inside of ChatGPT? Sponsored results in your AI. Will that bother you?
You know it's coming. I mean, it's a business. They're going to try to
Well,
make
we
money.
have to talk about this Code Red thing. Like,
Did you order the Code Red?
Sam Altman ordered the Code Red. This is the Wall Street Journal. I think it's a really big deal. And I know we don't want to, like, every time the media gets worked up over something, we don't want to just jump. But in this case, I think it's sort of a big deal that this stuff is, like, getting out there. OpenAI Chief Executive Sam Altman told employees Monday that the company was declaring a Code Red effort to improve the quality of ChatGPT and delaying other products as a result, according to an internal memo. Altman said AI had more work to do on the day-to-day experience of its chatbot, including improving personalization features for users, increasing speed and reliability, allowing it to answer a wider range of questions. So they're really spooked by Gemini.
As they should be.
And honestly, agentic my ass. None of this shit actually works. I have to, like, tell it the same thing every time I use it for the same function. It's supposed to, like, remember things.
Was it down for you? It was down for me like all day. I was using Gemini.
I don't know. Maybe we're all better off that it was down. It's starting to piss me off, honestly.
But Josh, you're right. I had to do an image for me yesterday for a thumbnail, and I said, "No, take this out. I don't need that." And I just stopped. It wasn't working. But I don't want to complain. It is magical, so I don't want to complain.
It's magic adjacent. It's magic adjacent.
No. How about this? It's not getting worse.
No,
it'll never be worse than it is.
I don't know if it's getting worse or not, but the promise of this was that it would remember the way you want things and be able to repeat that.
Yeah, but you're very difficult. You're very difficult.
I'm not difficult.
You're extremely difficult.
You know what I said to it? You know what I typed into it? I said, "Why can't you just do this the way you did it for me on Friday, asshole?" I did it. Like, because I do like research stuff in there, and I just want it the same way every time. I don't want to reteach it. Why do I have to reteach it things that I taught it twice, 3 times, 4 times? Why does it keep changing things up? And I think that's part of this Code Red thing. Like, I think they're hearing that complaint from a lot of people. Like, why is this thing freelancing? I already told it what I want. So are we being spoiled?
Oh, absolutely.
All right. Am I being
Remember Louis did a bit, I think it was a Letterman, or Conan, where people, this was years ago, but when Wi-Fi came to airplanes and people were like getting really upset that the Wi-Fi wasn't working when it just came into the sky. Like, yeah, dude, we're spoiled because this luxury is now a necessity. And when it doesn't work, I get pissed off.
Right. He's saying like the guy next to him or something, like the Wi-Fi didn't work. It was like the first time they ever had it. This is bullshit.
Yeah.
Right. Well, it's true. AI Secrets is saying developers have uncovered ad modules buried in ChatGPT's Android beta, including search ad, carousel, and bizarre content.
Yeah, obviously.
The timing is, but it's the timing. The timing is no accident. OpenAI's compute bill now runs into billions per quarter. HSBC projects that its much touted 2029 profitability target will not only fail, but sink into more than $100 billion in cumulative losses. After months of denial, the company seems ready to trade purity for revenue. The leak shows a fully formed ad system waiting for the green light. Okay, one day you're going to open this thing up. You're going to put in a query, a prompt, and you're going to get right above where you get your answer, you're going to get sponsored results. Something.
Are you acting like this is like breaking news? Of course it's coming.
But you're paying $20. It's like when they started airing commercials while you were watching cable. You're like, wait, I don't understand. I'm paying for cable and they're advertising to me? I'm telling you that this is not going to be popular.
Okay, then you could switch to Gemini, or you could switch to the other one that's going to...
They can't afford for more people to switch to Gemini. Gemini reported 650 million users in November, up from 480 million the month before. I don't think OpenAI can afford for more people to be turned off, but they also can't afford the cost of this build-out without more revenue than they're taking in today. I think it's a really big deal. I do not think they're launching an ad network from a position of strength. Sorry, I don't. I feel like they probably would prefer not to have to do this, but they might have to do it.
If OpenAI were public, how bad is it getting pummeled? I know we've asked this before, but
I think it's in a 30% drawdown.
Easy.
I think it made a high in September, and I think it's in a 30% drawdown. Just mentally. Because I think September is the last time they raised money, right? Was that the SoftBank? The $500 billion splash? So yeah, I think if this is a publicly traded stock, it is probably in a drawdown similar to whatever Meta's in.
Let's say it's down 40. Let's say it's worse, because I think it's down more than Oracle for sure.
Worse. Okay.
Would you buy it? I wouldn't.
I'd probably be afraid to.
Yeah.
Until it started going up, and then I would load the boat. All right. All right. We're up to make the case. This is you.
So
take it away.
Okay.
Take us home.
All right. So I'm going to make the case for energy stocks. I have not pulled the trigger yet. I don't own any of them. So I'm going to be piggybacking off some of the things that Josh said. I saw a chart this week that really caught my eye, and I said, you know what? It's time to make the case. Look at this chart from Turning Point Market Research. The 3-year rate of change. The S&P energy versus the S&P. Honestly, I don't even care what the story is. Like, honestly and literally, it is so far underperforming. It's the worst sector over the last 5 and 10 years. I think it's neck and neck with real estate. The S&P is up 230%. 280% the S&P over the last 10 years. Energy, this is total return, is up 97. Just massive laggard. But I'm going to make the case that if I were to buy it, I just buy the index, and here's why. This chart is from S&P Global. I'd never seen this before. This is chef's kiss. Let me explain what we're looking at, because it could be a bit confusing. On the x-axis, we're looking at the average dispersion. And what you'll notice all the way on the right is the sectors that have the most dispersion within them. In other words, the widest range between winners and losers is comm services, not surprising, and technology, also very much not surprising.
I would have guessed that.
Sure you would have. And then on the other end of the spectrum is energy stocks, which also you would have guessed, because if you were to compare like a shotgun blast, the technology and comm services, if these were like total returns for the year, it would be a very wide radius. Energy stocks, on the other hand, is a tight radius because they all move directionally the same because of the price of oil. So it has low average dispersion, meaning not a lot of opportunity for stock pickers, and the average correlation is by far the highest of any sector. And the number in the parentheses was a bit confusing. That's just a 12-month volatility, so you could ignore that. But energy, no dispersion, high correlation. So yeah, you could pick winners if you want, Josh. I know you like to. But if I'm gonna wait here, I'm just buying the index.
I pitched Baker Hughes today on the air. It's on the best stocks of the market list. Oil has not rallied at all. This stock is at a 52-week high. It is its third attempt to break through 50, or fourth attempt to break through 50. Stock looks incredible. You know what's not in this stock price? Anything positive. But one of two things. The first is the rig count. Baker Hughes actually has been publishing the weekly rig count since 1944. It's almost 100 years of data. That the rig counts are just dropping and dropping and dropping. And that sounds negative, but it's super positive, because when that turns, Baker Hughes itself is one of the first beneficiaries, because then everyone's earnings estimates have to start being raised higher. The more rigs, obviously, in production, the more work there is for oil field services companies like BKR to do. So that precipitous decline in rig count is super bullish when you look at the stock already at its all-time, at its 52-week high. That's one. Two, I have no idea if you get oil moving back to the upper end of its range, which is 80, 85. I have no guess even. But in any given year, like, the price of oil does not just sit at its low. So if and when that happens, this will be one of the first names they buy. So I'm blessing your make the case. I'm ratifying it, and I like it.
Do you own Baker Hughes?
I'm about to. I own PSX. I own the IEO, which is all of the producers. I probably should take a second look at. I've been talking positively about Exxon. Haven't pulled the trigger yet.
You know what else I like about energy? It does it is unlike the rest of the index in terms of the way that it moves. It truly is its own thing.
It's that, and then something that Nick Colas told me a while ago and stuck with me. It is your only true hedge against an oil price spike emergency. It is like there is no other real way for an equity portfolio to hedge that risk. Like you could have, I guess you could have like stop losses and trades on with your other holdings, or you could just keep a sleeve of energy stocks at all times. And that's like the perfect hedge for that particular type of risk. So anyway, a lot of these names are on my list, and we have some charts. So here's Baker Hughes. I don't know the story for why this breaks 50. I just know it's going to happen.
Next 10 points or higher.
Yeah, I don't know why it will. Here's Marathon. This stock's been working all year. This is a refiner. It's a little bit different. This doesn't trade on higher crude. It trades on a widening crack spread, which is the difference between the feedstock, which is the oil itself, and the price they can sell gasoline at. Like, just broadly speaking, that's what this trades on. This is the best stock in the market. This one I do own, Phillips 66 PSX. I don't know why this is going to go through 140. I just know it's about to. I don't know the story. I'll know it after, like everybody else. Here's Exxon. This one is not ready to go yet. But it's sort of like a pennant, and it's getting to a decision point, and it's closer to the upper end of its range than the lower. Say, what do they call this, Mike? An asymmetric triangle?
I think it's an
ascending triangle, whatever. It's gonna go. This one's gonna take a while. The other ones look closer. So these are all on my list. All right, mystery chart. We'll get out of here. I don't even know. All right, okay. These are two very closely related things. One is a stock, one is not a stock. What are we looking at?
One is a stock. Okay. Is the light blue line an interest rate?
It is not. It is another asset that is not a stock.
Is it an index?
The dark blue line. No, an index can't be an asset. It's an asset and a stock.
Okay, I hear you. An asset and a stock. Can you tell me which one is which? The light blue is an asset.
You want to glance at the live chat because they're kicking your ass right now.
No. All right. I don't know. Just tell me.
That's it? That's all you got?
Good one.
Not bad.
Good one.
Why aren't these things correlated anymore? It's interesting, right?
You have any theories?
So for those listening, we're looking at the triple Qs versus Bitcoin. They were not perfectly in lockstep, but as close as two things can be for the entirety of the year, of the last year. And then something just happened. And I don't know what it is, but the Qs are recovering faster than Bitcoin. Bitcoin's actually getting worse. I mean, today I know it bounced a little bit, but like this is not the same trade anymore.
No, it's
and I'm
very
wondering,
interesting. I don't know why.
I think they are inextricably linked to each other. I think there's a liquidity story going on with Bitcoin itself and some of the instruments that people use in the stock market to do Bitcoin-like trading. I don't know. We're gonna see how this develops, and maybe we're overcomplicating things, and Bitcoin will go up $10,000 over the next week and be right back up there with the Qs. But I just found that interesting. Do we have another chart? One or two more? So this is the actual correlation between Bitcoin and the triple Qs, and as you can see, this is the lowest correlation since the end of 2023.
Good
so
chart.
they have been much more tightly correlated for most of the last, 2 years. And you have to really go back to the pandemic to find a prior episode with less correlation between these two things. Is there one more or no? What else? MicroStrategy versus Bitcoin. Light blue is strategy.
I think the strategy story is over. I think the bottom is in. They just raised $1.45 billion like in USD reserves, LOL. I think at some point there is a level where the MNAV becomes so much less than the value of a Bitcoin holdings that just somebody steps in, not one person, but buyers step in and say, if I'm bullish Bitcoin, this is my leverage.
Can I tell you something ironical? The thing that saved Bitcoin today is that Vanguard came out and surprised everybody and announced that, okay, our brokerage customers are now able to buy crypto things on our platform. Why is that bullish for strategy?
I'm not saying that's bullish for strategy. I think
it's bullish for Bitcoin.
It's bullish for Bitcoin.
Right. In other words, they don't need strategy then. Because if you had a brokerage account at Vanguard, the way to get crypto exposure was strategy. And now Vanguard just said you don't need to do that. You can buy IBIT.
I would venture a guess that a lot of Vanguard investors are probably not buying strategy anyway.
Okay, great point. C. Paul Breezy in the chat says Bogle is rolling in his grave. I agree. Vanguard has historically said that they want to invest in things that produce a cash flow that can be valued.
You know
what?
And
this is just not that.
They're obviously listening. They're obviously listening to their clients, and their clients are asking. Otherwise, they wouldn't be doing this.
But you just said you don't think a lot of Vanguard clients would. So which is it?
I don't think. Don't gotcha me. I don't think Vanguard investors are buying strategy. I think they want.
You know what I would say?
Buy IBIT.
If you're the type of person who has all your money at Vanguard, you don't care about Bitcoin. So I think they're not listening to their customers. I think that's what they're trying to change. I think they're worried about getting the next wave of customers. So I don't think this is about listening to their customers at all, because I don't think their customers care. And if they did, they'd buy it off platform. I think this is more about we are losing out on the next generation because we're not allowing this. So,
Not untrue.
all right, that's a wrap from us. Guys, I want to remind everybody, first of all, thank you all for joining us live. We really appreciate it. I want to remind you, if you haven't subscribed to the channel, now would be an amazing time to do that before you log off. We also could use a like from you. So be super liberal with the like button. Just hit it as many times as you feel you need to. Listen to the koala at the bottom of the screen and subscribe. Tomorrow is Wednesday, all new Animal Spirits with Michael and Ben. And we'll be back at the end of the week with a new edition of The Compound and Friends. Thank you so much for watching and listening. We'll talk to you soon.